Awesome. Good to see you, David. How are you?
Good to see you, Ben. I'm doing well, thanks. How about yourself?
I'm doing well. Feeling much better, thanks.
Yeah, that was a crazy week you had, all right?
I got knocked on my ass, that's for sure. So,
Yeah,
but it goes quickly.
yeah.
It was
No
bad.
side effects now?
Slight cough.
Okay, not too bad.
No. Hey, why don't we start with what we were talking about? I'd love to learn more about what you're doing at InBeat and how you work with customers. Some things that maybe
Yeah.
um, companies, D2C brands that are new to influencer marketing should be thinking about, or maybe those that are currently doing it but having trouble, new things that they should be thinking about. And then I'd love to tell you a little bit about Bainbridge after that.
Sure, let's jump into it. So I'm co-founder and managing partner over at InBeat. We help direct-to-consumer brands leverage micro-influencers to create ads on TikTok, Facebook, Instagram, and Snapchat. We do that through vertical video, and the edge we have is essentially that we have a network of creators that have a track record for low CPAs or low CACs across the board. So we identify those top performing creators and we just reuse them across our different clients. So that's kind of what we do in a nutshell. We do the influencer casting and the ad management, and then we have software around that as well. So that's it in a nutshell.
How does a creator get good at this? I mean, is it just practice how do they know that they're getting low CPAs, for example? I mean, how do they get better?
Yeah. So the way we do it is we'll identify creators that have a high potential, right? And we have two types of creators that will brief and say like, hey, here's like your hook, here's your transition, like, okay, what's the benefit, put that forward, and then what's your call to action, right? We'll walk them through that kind of script. And other creators just get it, right? We're like, hey, here's the app, here's the e-commerce brand, here are the unique selling propositions, here's our target market, go ahead and run with it. And they'll just create an ad that outperforms the other ones. Really depends. Some creators are good at creating content but don't understand the ethos of the social media part. But other than that, yeah, we see it after that when we run ads against different creators for a different brand. So if a brand comes to us, we run ads with 10 creators. Some of them are just going to outshine the others. That's the fact.
And are you guys running the media, or do you create just the content and then the brand can decide to run the media themselves?
Yeah, we do both. We do both. So, a lot of teams come to us and they have they're managing paid media in-house and they're looking for influencer generated content stream. We'll help them with that, but we do the media. We have a media buying team as well on board. We help our brands, manage well over 500,000 a month in kind of paid media, and that's what we
Wow.
do here. So, yeah.
I was reading something recently about influencer marketing and UGC, and it was sort of and I think you see this in every channel, so I don't think it's unique to influencer, but, how do you keep things authentic, right?
Yeah.
How does, because presumably the idea of the influencer and the reason it works is people like that person, trust them to some degree, so how does it stay authentic?
I mean, that's when the casting becomes handy, right? Because actors feel authentic when they're playing their role, but they don't have to be. That's kind of our view on it. Some creators just feel authentic, right? And they can do that for 10 different brands. They can go from one skincare brand to another, and you'll feel that they're authentic. So it's really in like the person's ability to feel authentic. Obviously, there's like real authenticity where we'll try to build that as much as we can. Get the influencers to fall in love with the product. Talk to them on a one-on-one call like we're doing right now. Get them hyped up about the product. Kind of get them to buy in because that's gonna make our whole job a lot easier. But yeah, that's essentially how we build that authenticity.
Yeah, that's interesting. I think that's I think that's one of the hardest things about all these different channels is that they get worn out over time, or not worn out, but somebody's successful with it. Everybody piles
Yeah.
into the channel. The quality maybe starts going down, but there's still a lot of gold to be mined. And how do you do that effectively? And it sounds like you guys have really built an awesome platform for
And
doing that.
And I mean, to be fair, I think that this thing of, it's just going to be ad fatigue exposed as well. A year from now, we're going to be like, oh, wow, this tactical UGC that was working so well a year ago doesn't work. There's going to be something new. We're going to be taking new approaches to this whole thing. It just like, people get better at recognizing ads, whether it's created by other users or whether it's studio produced. So
Yeah.
we'll see how this goes. I'm curious to see, yeah, where we're gonna go with this.
Cool. Awesome. Well, thanks.
Yeah, yeah, appreciate it. And I'd love, just for you to bounce about Baybridge and what you guys do, and yeah, just start there.
Yeah. Well, thanks. We've built a platform to help D2C founders optimize their business. So what that means is first understanding what's going on in their business, and particularly around monetization and profitability, setting the right goals and objectives and plans, communicating those goals and plans to your team, and then tracking progress against that through a series of scorecards and dashboards that both the founders can use as well as the teams themselves and even individuals. So it's really what we found is that a lot of brands are they're very good at certain things, but they're maybe not as good at figuring out how to do growth or profitability or profitable growth. Maybe they're struggling with capital, getting the right debt or equity in place. And, that's often where things start breaking down because the low hanging fruit has been picked. They've kind of figured out how to do what works, but now they're like, how do I get that extra 5 points of margin? Or how do I go from 2 million to 20 million in sales? And the answer oftentimes is you do a lot of little things well. And,
Yeah,
and that given the complexity of D2C businesses is hard, right? Because,
that's interesting.
thanks. Yeah, I
Yeah,
mean, you think about like a D2C brand, you've got to be good at supply chain, right? Obviously, we've all learned that. You've got to be good at marketing and paid acquisition. You've got to be good at all these different channels, whether it's influencer or Instagram ads or TikTok and all of the above. Merchandising, fulfillment, logistics, finance, operations. So what happens is, all that complexity is very difficult to manage. And you find your margin in doing lots of little things better and better. And the beautiful thing about margin is that it compounds over time, right? So,
yeah,
if your business currently is making $5 for every $100 in sales, let's say $5 of profit for every $100 of sales, by compounding making these improvements to your margin, let's say you get that to 7 or 8 or 9 or 10, so that means that over time, every $100 you now make 7 or 8 or 9, that cash adds up quickly. Just think about it like as if you had invested in a bond or something like that. The more you invest and the faster you can cycle through it, the more money you make.
and how do you help kind of, I guess, leadership teams and direct to consumer brands derive insights from that data? I'm assuming they get that scorecard, and then after that they see like, okay, here's our operational costs, here's our fully loaded CAC, here's our merchandising costs, and then I guess where does like your tool come in to derive insights from there?
Well, that's a great question. So the first thing we do is we bring all the data together. So if you think about a D2C business and all that complexity, there's a lot of platforms. So Shopify, QuickBooks, Facebook, Google, influencer marketing, TikTok, Klaviyo, data's everywhere. Your 3PLs, your return systems. So you want to bring it all together, put it into a data warehouse, have that structured correctly so that you can access it and do the right analyses. Once you do that, the insights become a lot easier. I mean, this is kind of the promise that everybody, if you're at Wayfair or Amazon or one of these big brands, that they're trying to do internally, right? Build these data warehouses, hire all data engineers and data scientists and data analytics and FP&A analysts in order to get to those insights. But first you aggregate the data, put a nice data system together. So we do that for the customer. Next, you build the right analyses on top of that. And we've built a nice tool to help people understand LTV of audiences or customer segments by various attributes. So for example, a common question people might have is like, which first product purchased is my most profitable on a contribution margin basis? So that's a pretty simple question, but it can
Yeah,
take months and months of work for individuals to get to that answer. And we have a tool that you simply choose, your audiences, and you choose first product purchase, and then you can see contribution, you can see profitability on a gross profit net, and
that's
then contribution margin basis.
That's interesting.
And
Yeah.
then we build all that into a model. So we have, because the model is connected to the data, now what you can do is you can help prioritize projects, right? So now you've learned a little bit something about your business. So what metrics is it that are you going to choose to drive your business forward, and how impactful are those metrics? Because you have limited time and resources and people, so you don't want to focus them on the seventh most important thing. You want to focus them on the first most important thing. So by putting it
Yeah. I
into a
mean,
model, you can see the relative impacts of changing various metrics in your business on growth and profitability over time. So to help you.
and then how granular does this get then? Like, let's say you're looking at operations. How line item is that? Like to get these people to make the right decisions and prioritize projects. I'm curious, just
Well, you
from
certainly
my
can get
personal
down
curiosity.
to, the model goes as D2C, marketplaces, wholesale, retail. So you can break it out by your distribution channels. We have a pretty detailed chart of accounts for the P&L. So it gets down to a fairly fine-grained profitability, and then in the analytics we can understand, on a product level or a customer level or even a ad spend channel level, like is Facebook more profitable than TikTok, for example? Where we need you to get to then is like, what metrics do you need to drive in order to do that, to make these changes? And I'd say where we end is like, we're not going to, you wouldn't use our tool to be like, oh, if I, made the product yellow, not green, does that, what happens there? There's sort of a level of
Yeah,
specificity which you have to decide, through intuition or your own other tools.
that's interesting. And then do you have, like, just to wrap it up, do you have an example on top of mind of a client that used your software to make a pivotal decision in their business?
Yeah, we do. We have one customer when we were onboarding them. It was a performance outerwear company, focused really on the winter season. And we noticed when we onboarded them that their fulfillment costs, their contribution margin seemed really low when we benchmarked it against all of our other customers. So that's another benefit of Bainbridge, is because we see all this data, we can benchmark. So we're like, wow, their contribution margin is really low compared to other customers, and even compared to apparel. What's going on? So then we dug into the fulfillment costs and realized, like, man, their per order shipping is like, twice if not three times what other people are paying. So what's going on in their fulfillment? And then we were able to keep digging in, by getting access, working with their team to get the contracts. Realize that their fulfillment partner was basically overbilling them on
Like crazy, I guess,
order
if you're
like crazy.
saying
So
3 to 1.
yeah, so just on that alone, we freed up $300,000 of cash in the first year, for that business. And other examples are, we've had customers that are out doing fundraisers, and as people know, it can be very difficult and time consuming, and also fraught with, if you don't get the due diligence right, deals can go sideways quickly. So we were able to help a customer move through their fundraising process much faster, complete their due diligence, and get the deal closed, which, doesn't sound like a huge deal, but in a market like today, that could have been the difference between getting funded or not, by
Yeah,
accelerating the due diligence by a month or more is, can make all the difference.
yeah, that's a huge time save. Thanks, Ben. Really appreciate you breaking that
Yeah,
down.
cool.
Yeah.
Well, let's talk about what you wanted, what you were suggesting at the beginning. Why don't we dive into
Yeah, I
that?
mean, so I've got a document that I've put together, sent you away, got some talking points in there, but let's scrap that document for a sec. And I'm just
Yeah.
curious, I've been seeing red left and right everywhere, and saw Shopify dropping to, God, by 80% up to from their all-time high. Just curious to see. Everyone is talking about retail going down. I'm just curious, what's your opinion? What are you seeing? I know you track the Bainbridge Index, and what are you seeing right now in this market?
Yeah, so the Bainbridge Index is an index of public D2C companies that we've put together. So it's selected. It's not meant to be exhaustive. People all have
Mm-hmm.
difference of opinions of what should or should not be on there. But sample companies that are on there are companies like Carter's, Yeti, Of course, now I can't remember.
Crocs, Lululemon.
Crocs,
Yeah, I've got it.
Lululemon, right?
Yeah.
Sort of the big public companies. Oh, Solo, etc. But what we don't have on there is like designer brands, for example, which would be mostly sold in their own stores or through
Yeah.
wholesale. So that's kind of the distinction we make is that is the majority of their revenue D2C. Clearly, everybody's been getting crushed. But to answer your bit broader question, and we have a post coming out actually tomorrow about this. We think that there's a confluence of several factors that are influencing the market right now. One is the fact that we're coming out of COVID. As people open up, their consumption habits are going to change, right? So less time inside now. Everybody, depending on what part of the world you're in, is spending more time outside, getting out more. So obviously, dollars are going to shift back towards in store, away from purely online. So that shift is just a given. The other thing that's happening is that, because people can travel and get out more, people are buying experiences, at the sake of goods. So, Airbnb is going to do well, travel is picking up,
Yeah.
restaurants and entertainment. If you looked at AMC's earnings, for example, they're killing it, right? Because people are now going back to the movies. So experiences over goods, right? So those are going to impact eComm, obviously. And then the really big unknown is that you have this incredibly high inflation environment, which most founders have never experienced in their life, right? You
Yeah.
have to be 40 something years old to have seen inflation like this. So what does that do? And I think the what people aren't necessarily totally grappling with yet is the impact of inflation throughout the margin structure of the business. So the inflation is going to impact you on COGS. It's going to impact you on inbound freight. It's going to impact you on, getting from Long Beach into your 3PL because of, fuel surcharges and increased labor costs. It's going to impact your pick and pack rates. It's going to impact your delivery rates. It's going to impact your return rates, your return costs. So you have this you can't just say, oh, inflation's 8% and that's it on the business. It's 8% across your entire margin structure, which really it hurts. So
Yeah.
you combine that with people's fear of raising prices. So my guess is that there's a lot of people that haven't raised prices enough to accommodate, to protect their margins. So we're going to be forced to to see that. Today's report was inflation still running at 8.3%. That's
That's crazy high, right? Have you seen that?
yeah.
I've I've never seen this in my life. I think it's my first time in a downturn ish of an economy doing business. It's going to be different for sure on our side.
Yeah.
It feels like there's fear. There's yeah, and I think you're right. Prices weren't raised enough by many brands to account for that 8%, which is probably going to cost a lot down the line because that's bottom line, right? That's just a direct impact on the bottom line. So it's going to hurt.
Well, and it's also spread unevenly, which is the 8% is the average of a basket of goods. Right?
Yeah.
So, one of the biggest drivers of inflation is fuel or energy prices, which is much higher. So you think of the reliance of D2C on
Transportation.
energy prices.
Yeah.
That energy price is getting baked in over in China, right? As they've got to move raw materials around, and then them to factory to the port. It's got to go across the ocean, more fuel, right? Port to truck to on and on. So that these fuel surcharges are really painful.
So disposable income from things to experiences, and we've got the inflationary effect of which is unevenly spread, and transportation is definitely accounting for a big part of that supply chain cost for last mile deliveries as well as manufacturing. Everything is affected by energy
Everything
prices
is
and
affected by
DTC.
it. Yeah,
Yep.
so you can't just say, oh, raise prices by 8%, that should do it. You really have to look at your entire margin structure to figure out how much it's
And then
changed and how do you protect it.
So based on your index, right, multiples of index valuation multiples, which is enterprise value divided by sales, you're tracking that and you're dividing enterprise value divided by EBITDA, right? Which means, what is enterprise value again? Valuation of the company minus or plus cash on hand or debt, right? That's what it is, the
Yeah,
EV.
it's the share price times share price, shares outstanding. So there's your equity, and then it's plus the debt. So if
Yeah.
a lot of these companies don't have a lot of debt, but if you had a ton of debt, you'd have that together. And then
And then
that,
from my yeah, sorry, go ahead, go ahead.
well, then that idea is that that's what it would cost for you to, somebody would come in with cash to buy everything. The entire, take control of everything. Now, obviously, you don't need all that cash to buy a company. But
Yeah.
that's the idea.
And then what are you seeing? Do you think these multiples are gonna keep crashing? Is there gonna be cheap acquisitions of direct to consumer companies happening? What are we gonna see? Because I feel like this multiple is going down, and it's been a trend, and it seems like it's gonna keep going down, right, with their current landscape. And I think a lot of these brands have a baked in growth obligation, right? The story is all based on growth. So if that growth stalls, then the multiples will crash some more. What do you think is the future there? No, it's a hard question, but I'm just curious on your
Well,
take. You know,
yeah, we've focused on all the bad things, right? The good news is
yeah,
that retail is what like
yeah,
25% of global GDP, right? So
yeah,
retail is not going away. The idea of people buying stuff is not going away, and the idea of like eComm being an ever greater share of retail is not going away. So a lot
yeah,
of the headlines that you're seeing, I think, are the growth rate headlines are moderating, so that people focus on that. But you've got to still remember that it wasn't growing at 18% a year. Maybe it's now down to 14% a year,
yeah,
but it's e-com as a share of retail, whether it's the U.S. or Europe or Asia or whatever, is still increasing pretty dramatically against a massive market, right? Quarter of
yeah.
the global economy. So I think the other thing that also is really interesting about retail, e-com being part of that, is that there's this constant cycle of creative destruction, right, which is based upon really rapid changing consumer tastes. So it's not like enterprise software where you get a customer and 30 years later you still have that customer. People's tastes change rapidly, and so offerings companies can grow and also contract, based on that change. So that's not going away either. So I think it's still a really exciting time. I think the biggest challenge for
Oh, yeah,
D2C brands is like, how do you navigate this like capital, the difficulty in getting capital? And the answer is you've got to be much more capital self-reliant. You've got to get to profitability faster, control your destiny,
yeah.
not be as reliant on outside equity.
Responsible growth is probably the word, right? This is what
Yeah,
we're gonna be seeing a lot more of. Where it's yeah, it's interesting. I'm curious to see how that pans out, because I agree with you that e-commerce is still there for the future. I think there was a big sugar rush, right? From what I understand, there
yeah,
was a lot of capital in the market, and there was a lot of growth around that was stimulated through paid media budgets that were
yeah,
out of this world, and acquisitions at all costs. I don't know, we can start diving into that, but we have some clients, I know that they've readjusted their payback periods, right? Because they were like, okay, like our CACs were just monstrous, right? We need to tone down these CACs, and you know how these paid media platform work, right? The more you want to grow, the higher your CAC will be, because it's an
yeah,
inventory and people are bidding against one another. So if you want to get a bigger part of the pie, you'll just need to pay more per eyeballs that see you. But now people are like, hey, we'd rather see less eyeballs, but actually, get them at a reasonable price. I guess that's a really good segment into like, what's a good payback period? I mean, you have a lot of data. You work with a lot of, clients that, to which you have access to their back end information from A to Z pretty much. What is a good payback period? What's that looking like? How are you thinking about that right now?
Well, that question depends on the business model of the company. So the payback period is first you've got to understand whether you're truly a first purchase only business or you do if you do have a true repeat business. So an example there would be let's take mattress companies versus meals in a box, right? So like a mattress company, like okay, Purple or Casper sells a mattress, but like you don't buy mattresses every year. You buy them every, I don't know, 5 years if you're lucky. Other people go longer. Maybe you bought a new house and you have to, you have 4 bedrooms. So you buy one and then you're just testing it out to see if you like it, and then you buy more. But if you're Purple, you're pretty first purchase centric, right? So your payback period is like, I need to get paid back on the first purchase.
Yeah, exactly. Because you're not gonna get a second
Right. And
purchase
everything
right
after
away.
that's kind of gravy. Isn't it awesome if we get it? But if we don't get it on the first purchase, we're kind of cooked. On the meal in the box, on the other hand, is like, your business model is predicated on repeat purchase.
Yeah.
So now the question is, okay, well, what's your contribution margin on these repeat purchases? What's your ability to drive those repeat purchases? And then to answer your question about what's a good payback period, how much capital do I have? Because what you've got to remember is like, what you should be doing is judging your payback period on a contribution margin basis. So contribution margin is sales minus COGS, right? Minus the cost to fulfill the order to the customer. It's really the money that's left over after you've shipped out and the customer has received your product.
So that's your contribution basis.
That's your contribution margin or profit.
Margin.
Right.
Yeah.
And so the way to think about that is that that contribution profit is the money that you now have to cover your overhead, your marketing and your overhead.
Yeah.
So so you can imagine that, like, to use a very basic example, let's say that you're, after your for each purchase, you generate $10 of contribution margin, right? And let's say your CAC is $100 to keep the math simple. Well, you're going to need 10 transactions, right, to just get back to break even. You still haven't made a profit, right? You're now at a zero on a contribution margin, and then you're going to need additional transactions on top of that to actually get profitable, right? To cover your marketing and you've covered your marketing with $100, but now to cover your OpEx. So then the question is, as a business, like, well, how likely am I to get those 10 extra transactions, or 2 or 1 or 300, whatever their business model is? And how much cash do I have to wait it out, while I get through those transactions? Because if the longer you have to wait, you sort of create this J curve, so to speak, where you are funding lots of ad spend and customer acquisition, and you're waiting for those customers to make enough purchases to get back above zero, right? And then actually profitable. So all that waiting time, if it's one customer, it doesn't seem like a big deal. But if it's 1,000 or 10,000 or 100,000 customers, it
adds up. Yeah.
Net, trough that you now have to be able to fund somehow, with cash.
And there's tons of risk baked into there if you're longer payback periods, because you can have cohort risks, right? You test a new channel, works really well, and you extrapolate your payback period of your other channels to it, and
that's right.
Might be very different.
That's
very,
right.
very different.
A big problem that people because it's just math, what people will sometimes do because it's easy to do is like, well, my CACs are $80. I can't make them any cheaper. So the way for me to figure this math out is to like extend my payback period, or increase my lifetime value, or whatever they want to call it. Which then says, oh, voila, I can afford to pay $80. In fact, I can now pay $100. But you have to remember, like, okay, you have to go out and get those people. You got to keep getting them to purchase for an even longer amount of time. which inherently has risk, right? As you said, like, as your payback period goes from 1 month to 24 months, let's say, like, maybe they change their email address. Maybe they're no longer interested in what you do. Maybe they die. Maybe they, move on to another brand. God knows what. Maybe you guys don't have the same quality. Endless, right? So you don't actually achieve that payback period, and then there's the J curve, right, of funding all that
Well,
growth without getting the payback from it.
what's the win? Like, what's the winner? So, I was I was looking at your Bainbridge index right now. I was like, holy cow, Crocs is a D2C brand. They're absolutely crushing it, right? And then they're a very interesting brand. Lots of brand equity means that they don't need to invest as much in paid media. They're a social phenomenon. They've got a very good viral flywheel built into their product. They've extended, with like I don't know if you've given a bit in Crocs, but they have like what they call gibbets, these little Croc charms, and I think that thing is representing $160 million a year in
Yeah.
sales, which is absolutely nuts, right? When you think of the margins on that. So to my sense, Crocs is an amazing direct-to-consumer brand, right? But it's not a direct-to-consumer brand. It's a retail brand that became direct-to-consumer.
Yeah.
So I guess I had that question in the document from when I was looking at your index, but I have the feeling that brands that were retail that are going to direct-to-consumer are outperforming brands that went direct to consumer to retail because we're seeing these effects and go. And then I'd love to clarify that because maybe I'm off the mark, but it feels that way. I feel like
Yeah.
Lululemon now is absolutely crushing it in terms of D2C, and they're definitely a retail first brand, and now
Yeah.
they're probably a direct to consumer brand if you look
Yeah.
at it.
Well, I don't. I certainly don't. I don't know I don't have data. We've never run the analysis to say like, do D2C
Yeah, that
first
would be a
brands do better or retail does better? Going the other way. I think that's a really interesting analysis. But it's a little bit of a people use the word brand, right? Like we're using the word
yeah
brand, and what does that really mean? And I think what the brand, what we would argue is that the brand is really the ability to monetize above utility value, right? So what's interesting about brands is that because you build in this loyalty base or affinity, right? Which Crocs, as you were describing, certainly has done an incredible job of, and Lululemon has done an incredible job of. They can monetize that customer base at higher price points and more frequently than the simple kind of utility value of leggings or shoes or
yeah
sandals, right? And if you take it to the extreme, like a luxury brand, what if you're buying a Birkin bag, right? You're buying like a few $100s of materials plus like a few $100s of craftsmanship and pulling it together, and then you're buying tens of thousands of dollars of brand,
which is crazy. Yeah,
which is
exactly. That's
which is
powerful.
well, right. The utility value of a Birkin bag is like pretty damn low. It's like $20, whatever, right?
Yeah.
But the brand value means everything, and I'm not arguing that a Birkin bag isn't worth it. It very well could be. I mean, we all have our things that we like, whether they're cars or houses or vacations or whatever. We all pay more than the utility value, for certain brand experiences. I think that what is lost in some of this around D2C and da 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 is like ultimately your goal is to build brands that can
Yeah.
monetize at a above utility or above average value. And if you can do that, then you can build in profitability and you can build in durable profitability. And then you've built something really valuable, which you can then monetize. And there's a lot of people who want to buy that because it's hard.
Yeah.
And
It's
that's the
interesting
difference
because
between that and being an Amazon seller, which is like, I sell this, phone case cover, which frankly you could go buy from, 9,000 other people. So, I'm just focused on price and, kind of eking out one little bit of profit at a time, but I'm not
and
expecting to ever come back.
no, exactly. And you're looking at CAC as a very, quantitative thing, whereas, the brand behind Crocs, right? If you look at the Crocs brand or the Lululemon brand, like on a quantitative basis, their brand lowers their CAC significantly, right?
Yeah.
From like a pure quantitative perspective, that brand is allows you to acquire customers on the cheap compared to, the Amazon brand who has to bid every time to sell its pair of leggings for utility value plus XYZ depending on the reviews, right? And even that is utilitarian value. And I mean, but you're looking at it from a very, yeah. I think, yeah, the brand affinity side is probably what makes these brands that are winning, all that good.
Oh yeah, I mean I think that's what makes why starting a D2C brand is really interesting and compelling because like you don't have to become Hermes sized or Lululemon sized in order to build a really nice business. Or to put it another way, like if you had a 20% EBITDA margin, which would be very good but not unheard of, and there's brands in the Bainbridge Index which are much higher even.
Yeah.
You had a 20% EBITDA margin and you wanted to make $1 million a year as the owner of a business, you're describing a $5 million a year business.
Which is very low compared to a
Yeah,
brand would have a 5% EBITDA margin. You're like,
yeah,
hey, you need four times that. You need a $20 million business, and it's,
yeah,
yeah, it's very.
yeah. So I mean, I don't.
And I feel,
Sorry, go ahead.
yeah, I feel that in those like $5 million a year EBITDA, and $1 million a year, like 20% EBITDA brands, you're gonna have a lot of brands that appeal to a very specific set of highly engaged individual. If I
Yeah,
was to go and build a brand like that, I would probably build onto a trend like Build for Life, right, and build laptop bags around that. I would go for a trend of people that are highly engaged. Look on subreddits. How are people being engaged to products? What are they deeply caring about? Like gardening is probably one where you can just build a cult following around your brand by being a micro brand, and you don't need to be mainstream, and you can have very high margins because people will just buy into the movement more than they will into the utility value.
well, that's
That's
right.
probably how I'd go.
That's right. I think that's because you need a certain group, a tribe. I've heard one
Yeah.
describe it, right? That is really excited about what you're doing, and I think that's what's beautiful about a lot of these D2C founders is that they figured that out, right? Innately, either they represent the tribe or they understand that tribe very deeply, and so they can build really strong affinities and groups of customer bases, which they don't need to scale to massive levels in order to become really profitable and build a nice business. And by the way, to give you asked a question earlier about like exits. Well, selling $1 million EBITDA business there's certainly going to be buyers. But if you had a $5 million a year EBITDA business, so now we're describing a company that's doing the same margin structure, doing 25 million a year in sales, and it's 5 million in EBITDA. And let's say it's growing reasonably like 20% a year or something like that. You've opened up an enormous buyership for that business. I mean,
Yeah.
you
I
have
mean, you're
private equity, you have a lot of people that are interested in your business. So, can you get to a $5 million a year business kicking off $1 million to 25 kicking off 5 million? Like, I think you can. I think you'd be surprised at how many companies are doing things like that, or at least getting the top line, and then they need help getting the margin structure right to get the EBITDA right.
and that EBITDA is definitely where it's at, right? It's I mean, because everything you're gonna optimize for is directly impacted on the is you feel it on the bottom line essentially every time you'll fix something. Like if you
Yeah,
fix your cost structure by 3%, that's a plus 3% on your bottom line.
that's
It's
right.
it's directly.
Well, and also it's like at a very base level, right? Like it's there's no trick to taking $1 and selling it for 80 cents, right? Like
No.
we can all do that.
Yeah.
So if
Yeah.
you consistently are losing money, like you've proven nothing, right? Um, Not to say that losing money is bad. I mean, it happens, and especially as you get to these things. But it's the proof is in the pudding, right? Like you have this positive EBITDA that also is growing over time, like you've now proven. I mean, for the vast majority of companies, I mean, there's the kind of Jeff Bezos, Amazon, strategy of like your margin is my opportunity, which can work for
works
Amazon
for
and
a
it can
couple
work for
players.
nobody else, right?
Yeah, exactly. It works for one or two players that are, playing a 25-year window that have access to, yeah,
Unlimited
it's a
capital.
yeah, exactly. So it works in that sense, but
Yeah.
for most of us, it's not the way we're building businesses, right? It's like, or else you're going to be
Yeah.
miserable. And
So I think that to sort of go back to what you were talking about before, like part of the problem, with this is like we went from this world of like everybody was expecting to hammer away at top line growth and lots of ad dollars, and got I think a little away from like, well, what are we really trying to do here? And we're trying to build brands that are profitable, and build profitable growth. So ad spend is just a shortcut to that brand equity, essentially.
yeah,
So,
yeah,
did the pendulum swing too far on that? Like probably, and will there be an opportunity for that in the future? Like absolutely. But for the meantime, the game's not over. It just means like go back to what is really important, which is building brand and profitable growth.
yeah. Profitable growth is the key. Is the key. And what are you seeing right now, like in terms of your customers, the brands you're following? Like who has an advantage and why in this given state?
Well, I mean, certainly, outside of the brands that just sort of got the trend right, like, oh, I'm the brand that's really good for trips now or something. I don't know, I'm making up, I don't know. But I think that like an enduring advantage is consumables. Those are that have built-in repeat purchases, that you can quickly build affinity and that habit among the customers. So investors and buyers love consumables. So an example of when I say consumable, it's not just food and beverage, but it's beauty brands,
Yeah,
things that you use and you use up and then you have to repurchase, right? As opposed to hard goods like clothing or things like that, where you're repurchasing on a much slower time frame. So
yeah. I
consumables are
think
great, and then the other kind of niche to that is like consumables with very manageable fulfillment costs. I think are particularly good, right? So an example, like that's one of the reasons everybody loves supplements and vitamins and things like that.
yeah, exactly. That's
You could store, I could store a mass, in my office, I could store, in 6 months of supply, whatever, for a small brand, right? Whereas, like, if I'm selling trampolines, I've got a 50,000 square foot warehouse, right? So I think that's a big part of the mix is the fulfillment costs and the consumables.
good example is Athletic Greens. I feel like, very powerful brand. They're like, I think their retainer is like at $80 a month or something like that. So, targeting high performance, individuals that have an ache for performance, and they're just getting probably like, $1,000 LTV based on these clients. It's absolutely crazy. So,
Yeah.
yeah,
Well, I think that's an interesting, the other thing that to think about is the in the U.S. at least the income distribution is really uneven, right? So if you look
hmm
at the data, from the government data on household income, and I'm going to butcher this stat, but there's a few million households with above like 100,000 of income. It's not. And then if you start going up into the 200 or higher range, you're into low millions very quickly, right? So that's another thing that I think is like, you're talking about like, that the brand Athletic Greens, that has like $1,000 a year revenue stream per customer. Like, well, they're describing a very
That's
small part of the population. Now, obviously, there's people that are like, I don't make that much money, but I super prioritize that in my life. So you can pull those people up with you. But
yeah, but 1,000 customers paying you 1,000 a year, is $1 million in revenue.
yep,
When you look at it, it's crazy, right? You don't need that many to. I
you
think
know,
they're running at 100. I think they're running at 100 million in revenue, if I recall. I don't want to butcher their numbers, but you extrapolate that, and you're like, oh, they don't have that many customers. Probably they probably
yeah,
have like 100,000 customers paying that thing, and there you go. You've
yeah,
got your
right. But if they were to if well, I mean, I'm not super familiar with this company, so I'm gonna at the risk of like getting it completely wrong. But like, a mistake that I would think they could make is saying, oh, we should try to expand our tribe or our affinity group,
mm,
to 200 million Americans. Well, hang on a second. Like you could spend all the money you want, but there's only so many Americans that can actually afford this, right?
yeah,
So
and you might alienate your other tribe, right? You
that's
don't
right.
want because yeah,
That's right. So like I think that's the I have this theory or it's probably more of a hypothesis, but like that, a lot of brands they're kind of limited. They have a
hmm
TAM that's kind of prescribed for them based on their affinity, and it's when they try to escape that TAM that they get themselves in trouble. And the ways that they try to escape that TAM are often by spending more money on ads, right?
yeah,
So to think about it another way, like you convert you convert the lowest hanging fruit first. So as you run ads at audiences, it's the people that are most interested in.
yeah. The ones that are buying, like pulling out the credit card,
That's
and
right.
just buying, right? Yeah,
You convert those right off the bat, and then but people are like, oh, that was easy. Let me go. If I just spend more, if I go out to these other audiences, and the problem is the more you convert the low hanging of those audiences. But then as you try to convert somebody who's like less interested in the product or the offering or less able to pay for it, you have to be spending more and more to sort of effectively reach higher up into the tree. And that's why your CACs start getting, so much harder is because you're
yeah,
trying to throw money at converting people who just aren't as interested as converting as the other people that you already converted. You're
yeah. That's
right.
very true.
And that's I think and then that goes back to like, well, the brand, right? Like, why was it that those people converted so effectively at the beginning, and it's harder as you get you try to reach more people, and it's some of it's in,
We're all about growth, right, Ben? That's what the that's what the issue is, isn't it? It's like, okay, you reach that market, you're like, what's next? Well, there's obviously, you're making a 10 million, there's 100 million. You're making 100 million, there's going to be $1 billion, right? That's
yeah,
how all these brands operate. That's how they
yeah,
and there's a limit, there's a cap. I agree with you. And then extending it to other product lines, you run the risk of diluting your current customer base if you're
yeah,
trying to go down market or up market, or it's very dangerous to go like to target other personas and
yeah,
while preserving your original market.
yeah. I mean, it's you made me think of an interesting point, which is like, let's say that you were a $10 million in sales, and you had a 10% EBITDA margin, so you're making $1 million, right? And you're like, I want to do. It might be harder for you to go from 10 million to 20 million in order to make 2 million, right? Of
Yeah,
EBITDA, than to go from 10 million to 11 million, but increase your EBITDA margin to 20%.
yeah.
It might be easier to do that. So you'd be like, okay, now I'm making 11 million top line, and whatever.
That's like the uncool way, right? That's the uncool way, the unheadlined way, of doing that, isn't it? It's like, hey, we're gonna grow by 1 million and double our EBITDA, right? But that's the way it should be. But it's like, it's top line is what people are chasing, and
Yeah,
we've been guilty of that on our side too, of like, hey, revenue, 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 and you're like, you look at account profitability, and you're like, okay, wait a second, like we've got segments that are carrying over a lot of the cost for other segment. It's like, okay, well, let's get rid of the clients that are not with the fit with us, and let's like redo that. And you increase the EBITDA like crazy because you do that exercise. And it's like, we get carried away. Just, it's great. You sign the contract. It ends up being on the P&L. We get a bump in revenue. It's fun, but we all do that. I mean, and it's like an exercise that I have an advisor who walks me through that all the time. Like, okay, let's look at account profitability. Yeah, just like, okay, who's your best customer? Like A, B, C, D, who's paying you well? And then, you can do that for e-commerce brands as well. You can see like who are your best customers, not complaining, rebuying, like especially if you're consumable, who are your worst customers, right? And then what do you do to get more of those best customers? And then the CAC of your best customer is not the same as the CAC of your, D-tier customer.
Right.
That's another hard thing to see in a Facebook Ads Manager and a Google Analytics, right? It's very quantitative and very little qualitative into it.
That's a great insight. I think that's absolutely true. That you tend to chase what you can measure and where the stats are, and paid acquisition is amazing at generating stats and dashboards and things to chase.
Yeah.
And then the other kind of fallacy that exists in there is that people are working off of averages. So what I mean by that is like, oh, well, if I add, an extra customer, that means the contribution, this amount of, here's what the CAC for it, this amount of gross profit, this amount of contribution profit. But the truth is like you might be acquiring pretty shitty customers. We heard from a really big, big brand for D2C, $300 million brand. The CEO was like, it took us years to figure this out, but like that, but we were, backpacks were just completely unprofitable for us. We put all the focus over years on backpacks because they sold really well and they had pretty high price points. So they were busy adding backpacks. And he's like, when we did the math, when we finally looked at all the stats, we're like, backpack buyers never come back. So they're all this like one hit revenue that wasn't turning into the brand value and repeat.
Yeah, that's just how people are reporting, right? Backpacks end up adding on top line because a backpack is what, $100, so it's like more than that probably, and it's like just adds really well, but that's right. Very low, very low. Yeah, that's a funny insight. Yeah, that's exactly. That's why you need to use common sense a lot of the time. You get these insights by just going into it and mindlessly chopping things up and following your hunch and then stumbling on. Like, is there a way to like detect those insights?
Well, sure, through Bainbridge.
Yeah, exactly. There you go. You got
to ask the right questions. I mean, people know for the most part. I think people know the questions. It's getting to the answers that's really hard, right? So a lot of people. I don't think it would be an insight, revelation for somebody to be like, geez, what products that people first purchase products are the most profitable, that lead to the most repeat purchases and highest contribution margin, and which is the worst, and what does Facebook operate better? Customers from Facebook do better than customers from TikTok or Snapchat.
Yeah.
I think people know the things, but it's really difficult to get to those answers, and that's why people then look for metrics and averages, because you can't just stop your business. You can be like, let's figure that out. Let's spend 6 months and I won't make a decision.
Yeah, the back to school is coming. You need to get those backpack out. It's like, it's
back to ads manager, and then they're like hammering away at what they're familiar with.
And and there's someone in the organization that's incentivized to how many backpacks are sold. So they're not gonna
Right, or somebody, you set the wrong goal, right? Oh, our goal is to grow revenue, and then someone's like, well, I know how to do that. I'll sell a ton of backpacks. That didn't work.
I guess we can end it here. It was a good conversation. I really enjoyed it. It went by really fast. Really insightful to speak with you, Ben.
Yeah, I really enjoyed it as well, David, and I look forward to chatting again soon.